Okay, my friends, American Tower or Crown Castle, so specialized cell phone tower REITs. We are going to look at some of these options today and try and discern and discover which of these might be better for which type of investor, and I'll give you my thoughts on each one and why I'll be adding to one of these or starting position in one of these and adding to it over coming weeks. We'll look at some of the options there and try and understand when it might be suitable for you under your circumstances as an investor. Hey, look, if this is interesting to you or you hold either of these investments already or looking to add them, hit me down below with a comment and let us know what your thoughts are on these investments. If you're interested in learning to grow your dividend income, then hit subscribe and stay with me on this journey. Okay, first thing to note is we are looking at the adjusted funds from operations, and so prices to adjusted funds from operation are kind of going to be like the price to earnings or ratio that we'd normally see when looking at a corporate. Now, like many REITs, I think both American Tower and Crown Castle are both relatively easy to predict. They give relatively good guidance to analysts and they do a good job of chugging along nicely. So here with American Tower, for example, 1 year forward estimates, the analysts get it right within 10% margin of error all of the time. 2 year forward estimates within a 20% margin of error. Again, analysts get it right. Full stop. End of story. So that is nice. American Tower. So what does this mean for us? Well, let's just see how they've developed over the last 10 years. You can see dividend growth rates of about, seems to be slowing down. It used to be 29-30%, down to about 20% in 2019, down to about 15% more recently. We'll have a look at how that's progressing as well. What does this mean in terms of compounded growth rate? We're talking about a 14% compounded growth rate over the last 10 years. So this is also during a big bull market, and it managed to beat the SPY. So of course, if you're buying this at the right time, an individual stock with relatively high fluctuations, you could have done quite well indeed over that period of time. Now, fast graphs, one of the things I do like about it is this forecasting calculator option that it does have. Now, if you switch this to the normal multiple, this is the standard or the historically demonstrated price to AFFO ratio. Again, that's like the PE ratio. And over the last 5 years, it was about 24%. So if prices return to this multiple, we're expecting to see potentially until the end of the 2025 year, we're expecting to see returns of about 13% per annum. Now that's through both the growth in the AFFO as well as the dividend yield, and we're basically here at sort of this fair value point here, where the price to AFFO is roughly what we might expect it to see. Now, is this reasonable? Well, analysts, yeah, they're always getting it a little bit wrong, but we can see these revisions here from 6 months ago through to the current thoughts about these estimates. And we can see there's been slight decreases over time, but nothing too substantial over the last 6 months. And we can see the credit rating here is BBB- from S&P. So a reasonably solid company indeed, with some reasonable total returns there. So what about Crown Castle? Crown Castle, BBB. We can see they've also had a pretty rough 2022 in terms of the stock price, with some recent bounces here. Now, if we switch over to their overall performance, we can see that they've had much lower dividend growth, down to about 10% in the last year. We can see that they have just also beaten the SPY since inception. And from this as well, we can sort of say, again, it fluctuates quite wildly compared to the SPY because it's an individual stock. So buying at the right time, you would have been able to do quite well with the stock. Now, if you look at the analyst scorecard, we can see these slivers of green here on the 1 and 2 year forwards, the rest of it yellow. So look, occasionally they beat analyst expectations. Most of the time they're at least hitting those analyst expectations. So again, they provide good guidance and a reasonably easy one for the analysts to actually estimate. Now, what does this mean then when we begin to use the forecasting calculator? So we can see here there's an analyst expectation of some very, very moderate growth here. We've got this again switched to the normal multiple. So in this case, it's just under 23 times price to AFFO for Crown Castle. And we can see here the 2025 year, there's an expectation that AFFO is going to go down. Now, if prices return to this multiple, and we include dividends and everything, we've got a 7.9% annualized rate of return. we look down here, we can see again the analyst expectations and estimates have been sort of declining over the last 6 months. Again, as we saw with American Tower, the decline is not substantial, but it is there, and that's something to be aware of, that these estimates could be revised downwards further. So which one of these am I going for? Well, very quickly, Crown Castle then has a roughly 4% dividend yield. We can see dividends are expected or estimated to increase over the years. When we look at the performance, we can see that there's a slower dividend growth rate. But if I switch over to American Tower, I can see a lower 2.5% dividend yield. And if I look at the performance, I can see that, again, there's a higher dividend growth rate. So if we're thinking about what this means, it means that, in my mind, as a very long-term investor, I would be investing in American Tower, and this is where I intend to start a position in the coming couple of weeks and grow the position a little bit. It has a lower dividend yield. That's okay for me. As I said, I'm a long-term investor. And this lower dividend yield in this position will be offset by higher dividend yields in other positions. But more importantly for me, I'm seeing some strong AFFO growth here forecasted, so double digits in 2024 and double digits again in 2025. And that's encouraging to me, and they also have a history of stronger dividend growth rates. And we can sort of see that here from dividends of about $5.86 a share through to perhaps even approaching $9 a share in 2025. Now, it's always difficult to get a good fix on this. For the long-term growth rate, the American Tower is expected to have about an 8.7% per annum AFFO growth rate over the next 5 years or so. And if we switch over to Crown Castle, they've got a very similar sort of long-term AFFO growth rate. So there's a little bit in it there, not too much. Ultimately, I think this is going to come down, for most investors, down to current yield, and if current yield is important to you, I think then Crown Castle is going to be your pick. If, on the other hand, long-term growth rates and long-term dividend growth is important, then I think American Tower is going to be a better pick for you. So if you think about how many years it's going to be until you retire, if you're several decades away, I would pick American Tower. If you're retired or closer to retirement, then I think Crown Castle is one to look for. If you're very worried about the creditworthiness of the company, then Crown Castle does have the superior credit rating, with American Tower having a slightly lower credit rating, but also a larger market cap there. So a couple of things there for you to look at. Certainly some tight races here. But for me, as I said, hey, look, I am going to start a position in American Tower. This will be as I said, a long-term, multi-decade position to hold and slowly grow over time. Now, of course, the growth rate could slow, and if the growth rate does slow, then I would expect the prices to go sideways or even potentially decline for several years. What does this mean? It means I need to be patient. It means that I need to have that very long-term perspective, and as I do that, I would expect this dividend yield to continue to grow. It looks from this ratio here, from the orange line to the white line as well, that the dividend yield is going to be well covered by the AFFO, and that is one thing I'm always really determined to see. I don't want a situation where the dividend yield is not well covered, or a couple of bad years might put the dividend at risk of a cut, as we have seen in AQN. So look, everybody, those are my thoughts to this. Let me know in the comments below which one of these companies you like more, and which one you think fits your personal circumstances better, and why. And I will see you soon in coming videos. And if this is useful to you, once again, do remember to hit the subscribe button to learn more about investing and growing your dividend wealth in the long term. Thank you, everybody. This is Lincoln signing out.